All righty, welcome to session 6 of the trading program. There's 3 more, including this one. Hopefully, I'm going to do it a little differently this time, where, as you can see, these blocks are here because I think people are struggling a little bit with understanding entry. If like you can look back on price action and understand what happened, right? It's easy to do that. But if you only have the intuition, well, that's annoying. That actually shows up if I hover over it. But if you're only able to see the current price and have to predict the future, it's a little bit harder for people to do that. So, and I understand that. So that's why I'm going to do it this way. We're going to go over the recent price action like we always do. I'm going to do it for SPX and for NAS. And then we're going to get into a few other things. So we'll start with that. I think there's, all right, 16 here. Welcome. All righty. So we haven't gone over these 2 charts because these are Thursday and Friday's price. So I'm not cherry picking. That's just the 2 most recent days of price, right? So, and I'm also going to try to incorporate some of these features. I know some people are struggling with understanding how market structure fits in with the liquidity-based fair value gap that I play. So I'll try to make it more clear in some aspects, but let's get into it. I didn't realize this is such a big little gap here, but we'll see. All right. Markets are closed tomorrow, by the way, so futures are open. They probably have a shortened schedule, but if you're trading outside the United States, there will be a lot less liquidity. So I recommend sizing down. The spreads will be higher. It could be more volatile. It just depends. But I wouldn't recommend making too many trades based off of that. So let's look at what we've got here. Now, this is the 9:30 price session. God, I wish they didn't do that. So this is the 9:30 price session we have here. No, it's not. I apologize. I don't know why. There we go. So that's the 9:30 price session we have. And the first thing that I always do is I try to figure out what does the market want to do on a daily basis. And like we said before, we had mentioned there's kind of 2 different paths that the market can take. And I'm specifically talking about the morning session, right? So let's say price starts out here. The price is typically going to kind of have like 3 or 4 patterns that it does throughout the day. You're going to have the steady uptrend. You'll have the steady downtrend, whatever. And then you have I would like to consider these the setups that I like the more. And it'll be price starts. You kind of have a attack on a set of liquidity. So if this is the opening price right here, and it'll attack buy side or sell side liquidity. So like say it's right here. The market will go after that liquidity above before creating the real trend of the day. Now, the morning session is likely going to be where that happens the most, and so vice versa for sells. So if you're at a strong uptrend, strong downtrend, and then the other scenario is going to be that, or it's going to be the opposite, where you kind of go down, taking that liquidity. Price starts here, goes after that liquidity here, and then it will break back and then create that trend. Now, what we're looking for is the setup that I always talk about. Is that buy side liquidity or sell side liquidity being taken, displacement, fair value gap, something looks like that. Now, trading this setup when the market is trending in a specific direction is much harder, right? Because I'm always looking for a trend direction change. So what I'm looking for is I'm looking for days where the probability of this and this happening is more than a steady trending market, right? It's much easier to trade this and this because when you see a steady trending market, let's say, for example, the NASDAQ is up 3%. Your brain just does not want to continue buying that because it just doesn't make any sense. Logically, financially, it just doesn't make any sense. So what I'm looking for in the morning sessions, when I'm trading anything, this could be anything. This could be gold. It could be anything. They all follow the similar patterns. is I'm looking for that first run at liquidity before the trend is actually created, right? I have much more probability of success taking a position at this level and at this level than I do trying to buy one of the dips here on the uptrend. Now, not always, but I would say most of the time. Okay, so with that kind of mentality in mind, we're applying the same principles, but you recognize the kind of trend of the market and so forth. So, for example, let's just briefly chart out the 9:30 sessions so we can see what's going on. 9:30, 9:30, and this is all Eastern time, Eastern Standard Time. 9:30, and we'll do one more. So this is how you can help determine what's the likelihood of something happening. So with this concept in mind right here, remember we're looking with it's much higher probability if the opening morning session takes some form of liquidity, creates our setup, and then the trend starts. Now this little move right here could be the 5-minute opening candle. It could be the opening hour, could be the opening 2 hours. Really is entirely dependent on where we have price. And that's kind of what I want to stick to today, is helping with the bias decision, because that's important. Now let's go back to, well, I'm going to cherry pick an extreme example just because it's a lot easier to do that. And then we'll go over some of the days before. Okay. So 9:30 session here, right? 9:30 session here. And just for context, we had just absolute extreme selling pressure. I don't want to change the time frame, but we're in a steady downtrend. Now, if I am looking for at 9:30, right, where do I think? Now, technically, I don't know what's going to happen. So let's chart this out. We have buy side liquidity right here above. Get rid of that. And then our most is probably down in this direction. Okay. Now, you also want to make sure you get what? The applicable liquidity zone. So there's a huge one down here. This is a very strong swing low. This is a double bottom swing low, right? So that's a very strong one. Now, if I see price trending in a specific direction, so here's what I would be looking for. I have my levels charted out for this day. I would want two things to happen for a probability chance to make money. Like, great, we have a trending market that happens to bottom out around 130. That's irrelevant to me. I don't really care. What I'm looking for is, well, first I'm looking for this damn chart path thing. There it is. So what I'm looking for is the open is I want price to take this liquidity and drop. It doesn't. The price does not get above to that liquidity. So in my mind, there's no play. There's nothing. I mean, you can make trades and other strategies you use, but based on the concepts that we're using, I just don't see anything there. So that's the first one. The second one is going to be a move lower to this liquidity zone. And as you can see, no setup was formed here. Nothing, right? Now, what else? The next major liquidity and the last one is down here. So I'm seeing I want price to get here before I start looking for setup. Now, this is a pretty textbook perfect example, but to understand that, I mean, to even reaffirm my suspicion. So let's look at price. Price dropped from 4.5% drop from 9:30 to 1:30. This is a extremely downtrend of a day, right? So, but I really want you guys to understand that the price in between these things don't matter. Nobody can predict it. Nobody, trust me. What I'm looking for is these setups to occur in areas of interest of mine. So I come here, I've charted out the areas of interest here, here, and here. And preferably my bias would be short because we're in a downtrend. So I would have loved for price to come up here, take that liquidity, see that displacement, fair value gap, and then sell off. But it doesn't happen. So now I let price decline to that zone, and then I wait for the setup. Doesn't happen. Okay, so let me delete this. Delete this. So now we know these little zones we're looking for to target. These are, you can call it points of interest, you can call it areas of opportunity, whatever you want to call it. So now I see this. I see the first setup created. We have a trend reversal fair value gap based on liquidity. Right? That's the strongest one. Trend reversal, fair value gap, liquidity based. And even stronger because listen, the market's not going to move 8% in a day, especially on the NASDAQ. So if you see it's down 5%, and then now you have a bullish reversal based on a strong double bottom swing liquidity, you have a fair value gap, you have 3 or 4 or 5 retests, so it's just kind of sitting there. And then you have expansion into the close of the market. This is the final hour of the market. But I really, really want you guys to understand that I'm not, in between here and here don't matter to me. Like nothing, that it's irrelevant. Now you could probably make an argument that there's a little bit of liquidity here at the double bottom, and sure, let's do the same thing. You can even mark that up if you want. Nothing. It's just a huge displacement candle below. So no, there's no inclination for me to say, hey, I think there's a bottom going to happen here. Well, no. So, but if you want to add that to your chart just to kind of train your brain, then that's fine. So we target this liquidity, nothing, target this liquidity, nothing, target this liquidity, nothing. Now my preference was here, didn't happen. So I'm looking for this, this, and this. Doesn't happen, doesn't happen, doesn't happen, so forth. Now, here is where, if you, based on, I know you guys, it's been a while since we talked about this, but just basic market structure where highs and lows, swing highs and swing lows. And that's kind of where the indicator comes in. I think I've got the multi-time frame on, so I can turn that off. Okay, well, it's not going to try to, it's not going to show on the 5-minute or 15-minute because it's not as sensitive. But if it was on the 5-minute, it would have showed this as a swing low or a swing high, and this would be the break of market structure, right? Because we have highs, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. Here's where the first higher low is formed, and then you have the break of that structure here. So you see that large displacement candle, and you know that the market structure internally has broken. So now we have a continuation of the upside. But this is kind of like the best case position. Like this is the bread and butter of smart money concepts. A lot of the things that you see present in how people trade appear here. Market structure is broken, liquidity is taken, fair value gap, a dip back into that gap, and then you have large move to the upside. But on the 5-minute, this would have showed a difference, but it just didn't recognize it as a high. So that's kind of the limitation. It didn't recognize this as a high, and this is an equal high. But Scott is working on refining some of that. But for the purposes of this, this is kind of the golden scenario. So let's go back to our price, our more recent price. Alrighty. All right, same thing here. This is the 9:30 session. Let's check in what is our likely. We've got liquidity up here, and we've got some down here. There's no rhyme or reason to how I'm drawing this. It doesn't matter. All right, so I see the opening session. And then you also want to make sure you have plotted out other fair value gaps that are important or not important. So this would be one right here. So fair value gap, played up to it. This would be a higher risk scenario once again, because this is not our typical, our high probability, like 99% of the time setup, but it does play into some of the principles. But back to what I was looking for is I have an area of interest here. I have an area of interest here because that's your most recent swing high and swing low, etc. Now, where did price, we talked about this last week, where did price open up? It opened up below the equal lows here. This is a relative equal lows. So when I say relative equal lows, they maybe not be exact, but they're pretty close. So price dropped, morning session sell off. Now, if you see price drop in a pre-market session, I don't know how many points did this drop? 712 to 525. And then right at open, you have price in a liquidity zone. You're likely to see some kind of candle like this get back above that liquidity zone. It's just how it happens. Now, I wouldn't typically mess with this. There might be a fair value gap on the 1 minute, but that's not the point of what we're talking about. We're just going to a little bit of higher time frame so you can see what we're looking for. Area of interest here, area of interest here. I would say when we're thinking about like probability of areas of interest, this is like a 90% probability, 90%, and this isn't our typical setup, but I would say give it like a 75% probability. So I've charted out my areas of interest, right? And now I'm looking for a setup. And pretend the price action from here on doesn't exist. So I have my areas of interest. Now, what are we looking for? Now, opening chart, opening price, forget all of this price exists, remember. So I would want to see a run at this liquidity and then a move higher. Or I would want to see a run at this liquidity and move lower for my highest probability setups, right? Now, medium probability, we have a run at the fair value gap that's created here. And then a sell-off. Remember, this is a less probability of this, but if the setup is still there, it's still applicable, right? But these are kind of the three scenarios that I'm looking for, because that's how most of the time the market moves in a way that we can predict it. So let's see what happens now on a smaller time frame. I'm sure there was a bunch of choppy price action up front, but all right. So price does get up to here. Nothing happens, just kind of choppy price action, so forth. Now, because a high was formed, now there is liquidity here. Does that make sense? Like on the 5 minute, it probably makes it a little more clear, but I don't want to lose my spot. But anytime you see a high, like a candle high, this is a relative high. Now you have a draw on liquidity into this fair value gap, and then you have a sell-off. Now, I'm pretty sure I took this trade because it met all of my criteria, except for it was fair value gap based, not liquidity based. So this is a previous fair value gap. This is liquidity. So this is going to be higher probability, as this is going to be your second highest probability. So it's all about probability. I mean, when it comes down to it, but this met all of my criteria except for this liquidity draw, fair value gap, retest, displacement, sell off, kind of textbook. But the point of this conversation is to try to plan out what you're expecting. And this is something that the mentees and I will do on a regular basis, is planning out what do you expect for the day, right? Now, if you're bearish, you're bullish, doesn't really matter that much. I know as someone had mentioned, they struggle with the daily bias concept, and it helps, but you really don't have to. You just have to wait for your higher probability setup. So based on this, we want to see liquidity, fair value gap, previous fair value gap, and liquidity down here. Now, price gets down here, nothing tells me that there's any, like there's no setup forms. We just slice right through it. So let's go to the next day. All right, 9:30, a little bit tricky here because there's not a whole lot of price to go off of recently, relatively recently. So let's get rid of this so it's not as confusing on the chart. So we're at 9:30 here. So this might be a little harder to pick up and understand, but on a larger time frame, this would be practically a double bottom, right? So your double bottom liquidity, and I would have drawn it. That's a bad example. I don't want to confuse people, so we'll do a shorter term for now. 9:30 here. Where do I have liquidity? I would have loved to see a draw on liquidity here before we see more downside. or on the flip side, it would be somewhere over here. So I'm not even going to pay attention to that. So my ideal scenario, would be a draw on liquidity and then more downside, but it doesn't happen. Same thing here. I would want to see a draw on liquidity. Probably here. And whoever, there was a couple people drawing liquidity like here. And you remember, you want to look for relative equal highs or relative equal lows. That's what you're really looking for. Now, I'm doing this on the 15-minute time frame, so there's going to be a lot of different things that happen on lower time frames. So like here, for example, there's a draw on liquidity that's formed from these equal highs, and then you see that sell off. But that's not really what the concept I'm trying to teach right now is where price action is most likely to go. And we'll do that. That's what we're going to do right here with these two boxes that I covered up the most recent price. So if anyone has any questions before we do that. What time do you check the Traditics numbers? I mean, I look through it pretty often. They won't change because options don't trade during the day or overnight, I mean. So they won't update until 9:30 anyways. So you can see them at night or check them whenever you want overnight, and then they'll change as soon as the market opens. The only thing that changes in pre-market is stock price. How many days back would you look for liquidity? As many as makes sense. Like it's all about relative, like how relevant is it? So we'll talk about that in our examples here. All right, let me clean it up a little bit. So we're right here at the 9:30, and we're trying to figure out what is the likely possible scenarios of the day. So where do I chart my liquidity? I've got some here. You've got some way up there, but that doesn't really matter to me. And then you've got some right here from that equal high. So price is going to open up, and then you have, it really depends. So there's some here as well, because this is also relevant price action. It just depends on how granular you want to get. So let's see 9:30 open. Apologies. 9:30 opens. What am I looking for? If I'm bearish or bullish, doesn't really matter. I'm looking for areas of interest on my setups at these specific price movements, price points. So let's see what happens here. Okay, so this is the opening session. And let me mark the 9:30 just so you guys can see. Okay, 9:30 is here. So what would I be expecting to happen? Here's the previous low, liquidity is below it. Now, it's an important concept to understand. It could be, I don't know, it could be this big, it could be this big, it could be this big. There's not really like a science to it. So you just have to kind of know that somewhere below here, you could see the setup. Okay. Now, the farther below, the more risky it becomes, because you could easily just come back and retest the structure before selling off. But for the most part, generality, just draw your box and understand that that's kind of what you're looking for. So at opening price, we don't have a run on this liquidity. Clearly, we have a straight sell-off here, no setup. Looks like just garbage. Now, here is where we have our first area of interest. We have a little fair value gap formed. I'm going to change the color. So that's where we have our first liquidity-based fair value gap. Okay. Now, let's see what happens next. Well, we have a break of that low. And this would be a scenario, I think, that the setup would have failed me if you were playing a loose stop. Let me check the 5-minute just to see. Yeah, so this is the caveat sometimes. So here is the previous low. We have displacement, retest on this is the 15-minute fair value gap, but it then later uses this same previous low to create another version of the setup. on the lower time frame. So now we have, this would have been the actual golden setup, formed here on the 15-minute, formed here on the 5-minute. You would have gotten stopped out, but this is just an example where, I mean, if you played a full position, you played the rules, you would have lost this one, but you would have made your money back on the exact same setup. So it's, take it with a grain of salt, but this is what I was looking for. I'm looking for liquidity draw. I knew that price, if what it wasn't going up here. So what do? We're looking for a liquidity to find that reversal. So where's the, okay. So in this example, this is what happened. You have the sell-off, and then you have the setup form, and then you have the bull run. And that's the part I want to catch. Now we got caught a little bit and got in one too early. But it happened. So I'm not going to say it's a perfect thing, but if you took both of them, you probably would have made more. You would have been net positive, is what I'm saying. And then the rest of the price action, not a whole lot. But this was the intraday bottom. So that's promising, right? Now, here is the liquidity, and then this liquidity zone was not created until this low was formed. Very important concept to understand is this was not here before, so we would have not known that this was going to happen. But here is the liquidity zone for. So instead of using it, instead of creating the setup here based off of this, it used this one to create it off of here. All right, so we'll go to the next day. We'll do another one, and then we'll do some on SPX, because this is probably the most important concept, is understanding where's your area of interest in doing this and where's not. You could find all day. I mean, any fair value gap, you shouldn't be taking them all. All right, so here's 9:30. So let's do, what do we got? We have liquidity here. And we have some liquidity here, because that's the lows. And then if you really want to get into the details, then you want to make sure you mark it out for teaching purposes or learning purposes. You can mark this one and this one. So what are we looking for? We don't want the trending days. Those are the worst kind of days. You want to trade this and this. You want pop, drop, and then a trend. Now, important to understand, remember, this could be a 1 minute candle. This could be a 5 minute. It could be 3 hours. This is not a, it's not a set time scale. So here we have our 4 time frames drawn. Now let's see what happens. Now, this is where we can kind of check other time frames. So let's see what happens. We have a draw on liquidity here up front. We have a fair value gap that's created right here. And I know that's probably a likely setup because it meets all of my criteria, right? Draw on opening liquidity and a sell-off. Now, our profit target is going to be a draw on other liquidity. So let's look down here. It comes, price just immediately attracts to here. Once again, we have targeted this as an area of interest based on our trading principles. And you can also, if you want to go all the way back here and see if there's any others, but there's not. But just based on this alone, this is an area of interest for a bull side setup. Now, doesn't appear to me that there is a fair value gap here. Let's check the 1 minute time frame. And there does not, oh, there is, sorry, right here. Now, if you had your stop loss at half of a point below, I guess you would have been stopped out here, but I would typically put it about, I don't know, 5 points. When I say points, like dollars for the NASDAQ. So I would have put it, I don't know, 10 points, $10. And I don't have mine set like monetary wise. I just look at the chart. And if I see price displace, like if you see displacement below this, then that's kind of when I know. But if it just dips here to create a relative equal bottom, this is a relative equal bottom. So that's fine. So you have a setup here. It's based on that liquidity that we identified, and then you have a trending market to the upside. Now here is the target because you have your fair value gap based on liquidity. You have a retest and then a sell-off. So now let's get rid of the previous price because now we have highs and lows to establish new price movements. So let's get rid of those two. So now we have, this is the closest relative equal. There we go. We'll get rid of that. All right, we'll leave it there. So same principle. This was formed based on the opening price action. Let's go to the 3-minute. That's what we were trading on. So here we are. Now, although we do not see a fair value gap, there is a draw on liquidity and there's displacement below the previous market structure. So here's kind of that structure that created. This is the line. When I say that, this is the line that created the liquidity up here. So when I say displaced below the liquidity line, this is what I'm talking about. Displaces below that. Now there's no fair value gap, so this is not a valid setup that we're talking about. But I just want to say that this is what I'm talking about. So far there was a setup here, and a retest here, and then once again there was also a liquidity retest, or sorry, a fair value gap retest before this nice little scalp sell. Let's check and see what the rest of the price action looked like. Yep, nothing really too special, but based on what we were talking about, remember, we want to know what is the target, what's the likelihood of things happening. That's really what we're after. All right, let's do, grab a drink, and then we'll do SPX. Let me know if you have any questions too. Make sure you're putting them. Oh, there's 4. Yes, I do 1, 3, and 5 mainly. Yeah, I don't want to mess with I understand. I'm trying to repeat this, but not actually. The second setup is at the end of the day. So you buy next day. Well, if it's at the end of the day, I don't recommend using these setups for swings. If you're on a 1, 3, or 5-minute or 15-minute, they're not swing-based setups. For those, you're going to be looking at the 4-hour and the daily. And I'll cover that. There's something I want to show on the crypto market about that. But if you're using the 1, 3, 5, 15, even the hour, it's not really, those aren't swing setups. That's just helpful in your trading. So other questions? All right. Actually, I won't do this because the price it's probably similar to NASDAQ. Let's go to, let's go to the crypto market. But I want to show something about using the daily version of these setups to help guide your bias. And I've talked about this before, but I think people are not doing it enough. So if I look at each of these reversal points, so the most aggressive high, the most aggressive high, the low, they all generally will have something in common. And it's generally speaking the setup that we know to understand, some type of fair value gap of some sort, some kind, doesn't matter what it is. So like, for example, the most recent top here is a fair value gap based displaced top retest sell off. And I'm not saying that you should take these trades. These are simply helpful. See, like right here, same thing, called the top here as well. Now there's not one here, sadly, but let's see. Now let's do the bottoms. Let's change the candle. No gap here, but there is a little one here. These are the bottoms. There is one here. There is one here. There is one here. Here. Now, what I'm illustrating here is that not every daily time frame or 4-hour time frame fair value gap marks the bottom, but generally speaking, a bottom will be marked by a fair value gap, or at least a relative bottom. So when I'm talking about relative bottoms or relative tops, I mean, this is a relative top here at 38.5, and then it bottoms out again at 29. I mean, this is how you kind of create that bias, right? You see these large displacements like this, and now you kind of shift your bias. So we have a very strong uptrend. We have our setup that's formed, especially up here where it's liquidity based, because you have liquidity here. But it start training your mind as to that's kind of what initiated my bias change, right? Now you come down here and you might say, well, this isn't the bottom, or this isn't the bottom, but this is the bottom. I mean, this is pretty damn close to the bottom about changing your bias, right? Liquidity is down here. That's what we're really looking for, but the actual bottom is not until 31.4. So I guess your bias would be off by about 3,000. Highs and lows of the day, changing the bias meaning. I'm not sure what you're asking. How did you learn about fair value gaps and liquidity? What is that you charting now? What? So bias has to do with the concept that I was talking about over here. This is what I'm talking about on bias. Like I'm looking for this or this to happen. Now, what is my bias? So if my bias is bullish and this happens and we go up and my bias is bullish, then we're most likely going to see an uptrending day. Now, if my bias is bullish and we see price go down, then that's kind of what I'm looking for. I'm looking for a trend reversal if I have a bullish bias, because that gives you more confidence to take this. Maybe it'll help if I put it in the chat, like a chart that looks like this. But so if I'm bullish and this is going straight up, that's a bad thing for me, because I don't want to take those trades. Remember, we're looking for reversal, liquidity-based reversals. So if I'm bullish and I see price going down, that's better for me actually. Because what do? I find my liquidity zone like this or like this, and I'm looking for our setup to form for the move that I'm looking for. Does that make sense? Grandpa, there are thousands of YouTube videos on smart money concept trading. There's probably millions at this point. Yes, the risk reward is going to be extremely good. Now let's go to the NASDAQ, or let's go to US, or no, we'll do something we don't really look at, IWMs. This is a Russell 2000. Oh. Now, what do we think marked the top of the market for IWM? The exact setup. Bearish fair value gap, 244. Now, this is significant, very significant, because we have a, generally speaking, this little consolidation channel. And retail sees this huge green candle, like this just massive green candle. And this is, it's a complete just mind fuck. Sorry for my French. But seeing this big breakout is just deadly to retail traders who just want to take long. But we know that we see a liquidity-based fair value gap, displacement, retest. Now this is a daily time frame. Daily time frame in a long-term consolidation period, this is just absolutely brutal to traders. And that marked the top of the Russell 2000. And since then, we have dropped from 242 to 165. You took the long trade on that breakout? Is that what you're talking about? Yeah, exactly. And it's, that's funny. I appreciate that you could admit that, because a lot of people did. A lot of people did, especially on a daily time frame. They saw this and they probably bought out a year, 6 months calls, and they just let them decay to nothing. So we know that these kind of things, especially, this is a huge green candle. Now this could have happened for a number of different reasons, but the point is, we use this daily time frame to create our bias for how the markets are going to move. So longer term setups mean longer term trends, as you can see clearly. Now, another thing you should also think about is when we're talking about the market structure. So highs and lows, etc. Highs and lows. That's what the market does. You have your high, your low, and so forth. High, low, high. Every time you break a low like this, especially in a trend, generally speaking, you want to be looking for reversal setups. So this is a liquidity-based reversal and so forth. You want to look like right here, it broke the low and then it popped. Because retail takes these short positions because they think, oh, we broke this support, we have to go lower. So what the market has a tendency to do almost every time is it breaks the low and then it retraces to a point of interest before the actual move to the downside. So for us, I would have, in these scenarios, what you want to do is you want to wait for those lows to be created, and then you want to wait for that retrace. And that retrace is really what you want to get in on. Now we have a pretty big gap here. Doesn't quite get up here, but I really want you guys to encourage you to start thinking about this differently, where you see a break of resistance or support, and this is not the move to get in on. Breakout trading is not the way to trade. Breakdown, breakout trading. So like here, for example, same thing. We have resistance here, huge green candle. Look, this is just another, it just makes me frustrated talking about this sometimes, because there's so much fake information out there on YouTube. So you see this resistance, huge green candle. This is just, oh, okay, retail's like, honey, can we get out the checkbook and can we buy some calls? No, that's not what you should do. This is a breakout and then the real move. And I have a feeling there's a fair value gap here. We have a retest of that, and then we have the real move, right? Now, what happens again is, look, here's support. We break that support, consolidate, and then retail is kind of like, oh, okay, well, if we break back above this, then we're going to be bulls. If we break below this, bears. So what they do is they take advantage of both of those scenarios. They drive price up, and then the real move is created. Now, what do we know here? There's liquidity down here. So they drive price below that. Retail's like, oh God, they just broke that huge resistance or huge support. So let's buy puts. Now, what do? They come back and they break that resistance so that now these retail guys are like, shit, we got to get back in calls now because the market's going up. And so it's just kind of toys with people. The support and resistance structure game is just a deadly scenario. So what you need to start thinking about, especially on creating your bias for these daily timeframes, is look where the liquidity is and look and see if you have a retrace. The retrace is where you want to get back into the market. Now, for this example, it's perfect because what do we have? We have a fair value gap right here. So retail is like, shit, we're breaking this resistance. We're going to the moon. And we know as smart money traders that there is a fair value gap here. And that's likely where we're going to see the real move. Let's do another example of, let's do something that's highly liquid like Amazon. Alrighty, so what do we have here? We have this top. So for those of you who have been following for Amazon, generally speaking, there's this consolidation pattern, whatever. But what has been marking the tops of this? It's kind of crazy when you look at it. Fair value gap, fair value gap, fair value gap. I know I'm getting repetitive, but it's, look, so for example, here we have a triple top. Triple top. Retail traders are just salivating at taking this breakout, just salivating. They see the breakout, they're like, oh God, we're going to the moon. Displacement below fair value gap, and then just bloodbath. These setups happen every single day, and you need to start thinking differently about them. Now, the scale of what happens is also very important. So for example, this is the daily time frame. So let's take and this is all about, so here is resistance from September of 2020, tested again in April of 21. This is a long period of consolidation. We have a breakout, fake out, whatever you want to call it, and then back down. You have another retest of this level. So retail traders have this marked down. Trust me, they have it marked down, and they are waiting to buy the breakout. So they probably bought this one because look, we have a huge green, and then they have this one. They probably bought this one as well. Huge green. And then we have what? The golden setup. And then that's where you see the real move. Now, let's look at what happens here. We have liquidity. Retail knows that this is a resistance. They're going to buy puts or sells, whatever you want to trade. They think, oh shit, this is definitely the broken resistance. Let's sell it. And then we drive price up. Now, the next major support is where? Here. So retail is like, well, here's a resistance. I'm going to buy the breakout. You see what? You see a big green. You see the reversal, the golden setup, and then that's where the real move comes in. Now we get down here back again, and retail is, if they got smarter, they're like, well, shit, we bounced here. Oh, sorry, this is the thought. Same concept here, but instead of playing the breakout, if the market wants to continue this price down, they'll bounce first. It bounces here. Look, it doesn't break this resistance or this liquidity. It bounces first before the actual move. So this is something to, this is an important concept actually. There's a question. Looks like Wyckoff distribution. Yes, not exactly my case. Face ripper, yeah. I'm seeing, yeah, you should dream about it. Do we buy puts or calls in 30 delta when playing gold instead of option? I'll have to come back with an answer on that one. The gray boxes are the fair value gaps, Grandpa. I'm just drawing the fair value gaps. It's just easier for me to do it because if I do it, if I have the fair value gaps on, there's going to be a ton. So I'm just drawing out specific ones that I want to talk about. So let's take this consolidation period for, or this little, so here's resistance, or sorry, here's resistance, here's support. If the market is going to continue up in a single direction, it's going to, it's trickery in both ways in terms of, so let's take this as resistance, retail resistance. If I'm a market maker, what I'm going to do, or the market in general, the algos, whatever you want to say, it's kind of holistic. I want to stop price here. I want to retrace think that it's retail resistance and they beat us, and then I want to drive price up. So that's kind of the intuition of knowing if the market wants to continue in the direction, right? Now, if you think that the market is going to break through it, or sorry, is going to reverse, then they'll do what they did here. They'll drive price above that liquidity into that liquidity zone from here, have the fair value gap, and then you'll see the real move. So it's kind of like it gives you a intuition. Let's find another example. So here's a triple bottom. I'll go to different stocks so we can see one. Let's try Netflix. Ultra volatile Netflix. So let's do, this is a good example because we have just your basic uptrend. So let's do the retail trend, something like there. Bounce, 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 so forth. Yeah, that's great. This is a retail uptrend, but we want to think about it differently from that. There's a couple different aspects. So we have lows, highs, lows, highs, low, high, low, high, low. Now, what do we have here? We have our first lower high. Now, where is the market structure broken within this setting? Here's a low. Here's where the market structure is broken. Now our bias changes. Now, if you're a retail trader, you probably bought puts here and then got faked out when they had that retrace back in this fair value gap. But we're just from a market structure standpoint, this helps you determine your bias, right? It's all about the bias. A lot of people, if you can accurately predict long-term bias, whatever, then you will be much more successful using this setup because you want to be taking the specific positions that line up with your bias. So for example, based on just very basic market structure principles, the low is violated here. This is a change of character on the daily time frame. Now your bias is short. And granted, it called the exact top, this setup. Won't always happen. Might have called the top to here and then retrace, but it called the exact top. And what do we also have? So I'll get rid of that. We have liquidity taken from the market. We'll go to the 4-hour. We have liquidity taken from the market. Boom. And then we have what? We have a fair value gap that's created. Oops, what the hell? I'm losing it. Fair value gap that is created here. And then that's where you see the downtrend. Now, if you see this kind of setup, you can either use this as a swing position and take 3 weeks, 4 weeks, 2 months out calls or puts, or you can use this to train your bias to say, I'm now going to be looking for what? That the chart that we talked about, or the kind of conditions that we talked about first, where we have a run on a call side liquidity and then the sell-off. So that's kind of what I use it for. But based on the market structure principles and the liquidity-based, displacement-based fair value gaps, this would be a good top level. Because once again, retail is thinking, hey, here's the top. We have liquidity taken, and then like it's just unfair to people who don't understand this kind of stuff. All right, now let's see if there's any other. Yeah, same thing down here. What do we have? Retail sees this previous resistance, takes puts, and the market clearly knows that has happened because they can see the positions that are taken. And we have a reversal. So the point is here is you're looking, if you're trying to trade with the trend, you don't want to enter on the bottom or the breakout. You'll never, long term, you will not succeed taking the breakout of this trend support here. You want to be waiting for the retrace. Always take the retrace every time you don't take the breakout or the breakdown. It's an important concept. Let's go do one more. Let's pick a meme stock at DraftKings. Now, this looks like a pretty gnarly chart. Pretty gnarly chart. So let's just do some quick long-term analysis to kind of help with our trend. Alrighty. Market structure, highs and lows. Now, a market structure like this is not broken unless there is two principles met, a lower high and a lower low. Right here, we have a lower high and a lower low, but not both. Same thing, and we continue the uptrend. Now, here is the first time that a lower high is formed and a lower low. Now, that pretty much marks the top of this bull trend for DraftKings, right? And then we have a large move to the downside. So if you FOMO'd into this position, you would have gotten roasted. Why? Why would you have gotten roasted? Because you didn't listen to the smart money principles telling you there's liquidity here. Retail would have bought the fake down. Maybe they made some money. Who cares? Maybe they did. But now you're stuck here, and then the retrace. The retrace is where we want to get in, right? Always the retrace. The retrace is here. But it doesn't last very long. I mean, you come back to this liquidity, but my point is you want to think differently. Market structure tells you the trend is broken here, but you don't want to get in here. You want to get on a retrace. Never buy a breakdown. Never buy a breakdown. Never sell a breakout. Never buy a breakdown, because you will get roasted. But you can use, there's a lot of different ways to help determine that. Now, let's get rid of this. It doesn't look like a lot of liquidity was taken, but definitely some. I'm sure someone took this trade. And then we have our setup that was formed to call the absolute top. So first we have a top called by our setup, and then we have market structure broken, and then the ultimate downtrend continues. And then what do we have? We have buy side liquidity over here, which is taken right here. Retail is buying calls because once again, they see they're trained. They're trained like little zombies to trade that look big green, big breakout. There's probably some more volume. So whoever teaches this YouTube course says there will big volume, big green breakout. That means buy. Well, no, it doesn't. Big volume, big green breakout means look for our liquidity based reversal, fair value gap, which created here, and then the trend continues. Now you might say, well, why is this? This is an actual breakout, right? But you shouldn't have taken it short here just because there's no setup formed. I'm not saying every liquidity zone is going, every high and every low is going to be a liquidity zone. I mean, every high and every low is going to be a liquidity zone, but it's the setup is not always going to form there. That can't happen, or the market would never go up. It would never go down, it would never go up. But we're looking to take positions in those zones is what I'm talking about. Right. And then we just absolute disgusting downtrend. But all right, it's 8:30. I'll answer some questions. Let's see. Yes, they are more affordable now because the premiums are lower. Yeah, they definitely are. These false moves are fascinating. Always be retracing. Yes. Always look for the retrace. What is best stock options using these methods for an account of 500 and build little by little? Aziz, if I'm going to be honest with you, small accounts are the hardest possible thing to trade with. I would probably try and save up enough for 1,000, and then I would be trading small cap stocks that have lower price points, like Trying to think. Blue chip stocks with low prices. It's gonna be your best bet. Holy crap! Netflix is at 175. Oh my lord, that is nuts. How come no one told me that? Netflix is another good example. I'll show you real quick. Even go to the weekly time frame. It's just a massive fake out, and then the real selling continues, but the real selling happens. This approach is that yes. The risk reward is the best for this type of trading. That is why I recommend it. Every strategy has a risk and reward. That's the name of the game, is figuring out the best one. What was the question? Yeah, so Aziz, I would try to get up to 1,000 and then start trading stocks that are sub $200, preferably sub 100. I'd be trading like yeah, Best Buy, Intel, even IWM, because it doesn't move. If a stock tends to move a lot, so it has implied volatility is high, then the contract prices will be more. Disney would probably be a good one to trade. Anything that's like sub 100. Sorry, what do you do after your short-term trades? What do I do after? After what? What do I do with the money? It depends. Right now I have liquidated my entire stock portfolio. I did that a while ago. I was very tech heavy for a lot of reasons, but I stopped. So based on just what I've been teaching, long-term trend is what controlled my decision to get out of. Oh my God, where is it? There it is. I got out about somewhere in here, beginning of this year, because the same principle I've talked about. We broke long-term structure, so now the selling is likely to continue. Didn't get out at the top. That's fine. But I will look to invest in a similar circumstance once we see a reversal in the market structure. So I'll buy a variety of ETFs, tech stocks, growth. That's a different conversation. But yeah, I'm pretty much all cash right now, equity wise, besides like my 401k. Real estate, since cash is deflating 11% now. Yeah, I am personally not confident in any investing market right now long term. But I will be on the sidelines looking to get in whenever the time is right. Alrighty. Well, I will let you all go. I'll post the recording. I hope you enjoyed the class. If you have any further questions, yep, SPXU, please let me know. If you want to leave a review, feel free to. There's a link in the Discord. You can do it about the indicators, about the course, anything you want, good or bad. I'm open to all of them, but I appreciate the support, and you guys have a great rest of your day.